Welcome to Profit and Prosper, a podcast for entrepreneurs who are ready to make some money while doing what they love. On this podcast, we're going to pull back the curtain and talk about all things business and money, but I promise you this is not your typical boring numbers talk. I'm your host, Sarah Young, a CPA and CFO with over a decade of experience in finance, business, and leadership. I'm going to share everything I've learned from helping my clients grow more profitable businesses and keep more of what they earn while growing my own successful business along the way. You'll feel empowered and confident that you too can grow your wealth, live a rich life, and have an impact. Stick with me and you might even start to think that finance is fun. Let's dive in. What's up, y'all? Welcome back to the Profit and Prosper podcast. In this week's episode, we're going to nerd out a little bit on some numbers because I have some real life client examples that just so perfectly summarize and show the difference in what happens when you optimize your business for profitability versus when you don't. I actually had a different episode planned for this week, and I actually just decided to hijack it and record this one instead because in the last week, my team was sending out financials. My Young & Co team was sending out financials to some of our clients, and I was reading through them as I do, and these two particular clients just really stood out to me, and I wanted to share just some of the stories behind what's going on. So I'm going to share real life client numbers. I'm not going to share a ton of details about like the exact type of business or anything like that because I don't want to like give away confidentiality stuff, but these are two service-based clients. That's what we basically only work with, service-based clients. Two service-based clients with essentially the same revenue, and they're in similar industries, not exactly the same, but similar industries. Similar enough industries to where their numbers, the benchmarks we would use would be similar for between both of them. And yet they have wildly different profitability. So I actually shared on my Instagram, if you want to go and see the actual numbers, if it's easier for you to see them versus hearing me say them out loud, go to my Instagram at It's Sarah Young and go look at the post from September 14th. In that carousel post, I think it's on the second slide, I list out the two numbers comparing client number one and client number two. So those are there. So client number one has been a client for a while. They started with us when they were in the six-figure revenue range, and we have scaled up our work with them as their business has scaled. Client number two is a newer client. And so we have not been working with them for as long. So we have not had time to like really put all of the changes in place and see the impact on the profitability. Although obviously that is something that is a high priority for us. To be fair to client number two, this one is the one that does not have the profitability that we would like. They thought they were getting the help that they needed. So when they came to us, they had a tax preparer, they had a bookkeeper. They were doing the things that, all business owners tend to do as they scale up, and yet they were not getting the support that they needed. And to be fair, a tax preparer and a bookkeeper are not going to really dive in the way that I'm about to share that we've done as a CFO. And even, as I can wear my CFO hat or my business strategy hat, in either case, like you need to have support on the overall strategic side, and tax prep work and bookkeeping work are not strategic. These are reactive services after the fact, just reporting on what happened. You're not getting the proactive strategy that you would need if you find yourself in a situation like client number two. Okay, so to be fair, they thought they were getting help and they were paying quite a lot of money for the support. In my opinion, in this case, like they were wildly overpaying for what they were getting, but that's just my opinion. I won't go down that rabbit hole. But they thought they were getting support. It just ended up not being to the level that they needed. So let's run through the numbers, and then I'm going to talk about the benchmarks that we look at and talk about what's happening to drive the differences between a highly profitable business and a not profitable business. So both clients are doing just under $2 million in revenue. Their gross profits, client number one is the one that has been with us longer, and they are hitting the benchmarks we want them to be hitting. Their gross profit was right at $1 million. And client number 2, the client that's not as profitable, their gross profit is $670,000. So client number 1's gross profit margin is right about 60%. Client number 2's gross profit margin is just under 40%. So that is a 20% swing in gross profit margin on the same revenue. And so that is driving over $300,000 in less profitability, right? So client number 2 has $330,000 less gross profit margin on the same amount of sales. So before I go further, let's talk about gross profit. Gross profit is one of the most important metrics that you as a business owner need to understand. And yet, I can guarantee that the vast majority of you listening do not know what your gross profit is because most bookkeepers are not going to show gross profit on a P&L. I actually had a tax client that, at my advice, this is not one of these two clients, this is another client. I'm going off on a tangent real quick. At my advice, they moved their team payroll cost up into cost of sales so that they could see gross profit. They were doing the bookkeeping themselves. And then more recently, they hired somebody to do the bookkeeping for them, and the bookkeepers moved it back. They moved their team costs back down into SG&A expense. So you can't see gross profit anymore. And I was like, oh, why? Like, why move it back? I rarely see financials from new clients coming in who report gross profit appropriately. Why? I don't know. You're using bookkeepers. And again, to be fair to bookkeepers aren't there to make the big picture strategy, systems, reporting decisions. They're there to code the transactions. So they're going to take the lead from the CFO, or in the case, if you don't have a CFO, then it's you. You are the CFO. So they're going to take your lead. And if you don't know to tell them to do that and help them understand how to show gross profit, they're not going to do it. So what needs to go into the math to calculate gross profit is cost of sales. So you have sales and then cost of sales. Sales minus cost of sales is your gross profit. What goes into cost of sales is the cost of everything it takes for you to provide the service. So you go and sell a new service, you're going to incur cost, team cost, maybe some supplies cost. Anything that you have to do to deliver that service to your client, that is cost of sales. So this would be client-facing team members, people who are doing the work in my business. That would be my bookkeepers, my tax accountants, my team who's doing the financial work. Whenever we get to the point in the near future where we hire another CFO, that's going to go in cost of sales. The cost of those team members goes in cost of sales because they are delivering the work to the clients. Versus other team members like admins, marketing team members, for example, those would not be cost of sales because they're not client facing. They're doing the back end work. You also want to include if you have supplies costs. For example, let's say you're a web designer and you have to buy a font or something when you're, creating a website for somebody. I would put the font cost in cost of sales because you couldn't do the website without the font. Home organizer, for example, we have several of those, like the cost of the material, the product that goes into your clients' houses, like that needs to be factored in to calculate gross profit. Things like that would need to go in cost of sales. So gross profit is basically what you keep after every sale. And this is really important because if you focus only on revenue, then you're not paying attention to, okay, if I'm incurring a cost every time I deliver a sale, then you need to care about how much of that sale am I actually keeping. So gross profit is what we're going to then allocate to cover your overhead expenses, your owner pay, your taxes, stuff like that. So gross profit is crucial. Client number 1, their gross profit margin was 60%. That means that out of every dollar they sold, they kept 60% of it to, hit their gross profit. Client number 2, their gross profit margin was 40%. So that is a 20% difference. On a business doing almost $2 million in revenue, this ended up being over $300,000 of a loss in profitability for client number 2 because their profit margin, their gross profit is too low. And I'll talk about why and why gross profit tends to be low in a second. Let's keep going through the rest of the financials. Client number 1, $1 million in gross profit. Client number 2, $670,000 in gross profit. Client number 1's overhead expenses, not including owner pay, I'm backing this out in this example, just all of the other costs associated with running their business, was $570,000. That leaves them with $430,000 in profit and owner pay combined. I've talked about this number before. This is what we would call owner discretionary earnings. This is a number that if you were to go sell your business, this earnings number is going to be what your value of your business is based on. Basically, the discretionary earnings part is just how much is your business generating that you as the owner have discretion over what you'd spend it on. So in this case, client number 1 had $430,000 of earnings. That was right about 25% of sales. Client number 2, so they had $670,000 of gross profit. Their expenses were $680,000. And so they're basically making no money. The owner cannot pay themselves. There are no discretionary earnings. So we have no profitability. So obviously you'd want your numbers to look more like client number 1. My benchmark for this earnings percentage, bottom line earnings, is generally going to be between 30 and 50% of revenue. So I have seen clients who can do 50% of their revenue in this bottom line earnings. I've seen some who can even go higher than that, just depending on the industry. But as a reasonable benchmark for most service-based businesses, I would say 30 to 50% of earnings, or actually 30 to 50% of sales. The smaller your business, the higher that should be. So a business doing like 100K in sales, I would say at least should be taking home 50% of that, ideally. As your business grows, you're just going to have more and more costs associated with running the business, but you can still get between 30 and 50% even in the 7-figure range. So if you're making, in this case, if you're making $2 million in revenue, then 30% would be $600,000 to $1 million in basically owner's earnings. That's pre-tax earnings. That would be legit, right? So the benchmark is 30 to 50%. Client number 1, I just said, was at 25%. And I will caveat, in the numbers that we have, they had a quarter where they had to do some like restructuring and they had a bunch of one-time costs. So when you back those out, their earnings are much higher. And in more recent months, they're trending upwards of 40% of revenue, which is amazing. Like their numbers, I could not make better if I wouldn't make them better. Like they're hitting all the benchmarks. Okay. So the benchmark would be 30 to 50% of earnings. So for client number 2, who has basically zero earnings, this is heavily driven by the gross profit that we talked about. So the gross profit margin of, being 40%, I would benchmark that for any service-based business. It needs to be at a minimum 50%. Depending on the industry, we have clients that go up to 80% in terms of gross profit margin. So that's different than the overall earnings. So if your gross profit margin is, let's say, in the case of client number 1, it's 60%. And then they are spending 35% of their revenue on expenses, leaving them with 25% in earnings. So obviously, in this case, I would like for their earnings to be higher. And in the more recent months where their earnings are higher, it's because their gross profit margin has been higher than 60%. It's been at like 65. And their expenses have stayed flat / they cut some. And so that's helping their overall bottom line profit. Client number 2, the biggest thing driving their lack of profitability is the gross profit margin. Their expenses are also $110,000 higher than client number 1. So obviously, I think there's some things to cut in expenses that would help them. The reason their expenses are higher is this business actually did a little bit higher levels of revenue in previous years, and their revenue has dropped, and they've not like cut the correlated expenses as their revenue has dropped. So, the expenses are definitely a factor, but in terms of the most powerful factor, it is the gross profit margin. All right, so we've talked about numbers, we've talked about the metrics of gross profit, and the overall earnings margin. So let's talk about the drivers of the number one factor for this business in terms of why, compared to a similar business, it is not profitable. And I see the same patterns happening with basically every service-based business that we have. And spoiler alert, it's going to be the same things that you hear me talk about all of the time. And so this is why I wanted to record this episode. I think that it's great because it so perfectly gives us an example of the two different businesses. So if you're just focusing on revenue and not paying attention to the other metrics on your P&L, you will very likely end up in a situation where you are not profitable. And I see this happen all the time. I almost feel like, I hate to say it, but I feel like it is the exception and not the rule. It is the exception to have a business like client number one that actually hits the benchmarks, because it takes work and it takes intention. It takes support too, in a lot of cases. The main drivers of gross profit, the things that we work with our clients to fix, tend to be pricing and team. And that sounds obvious, right? But let's talk a little bit more about what I mean by each of these. Pricing is obviously crucial, and a lot of people get it wrong. I literally just, in the last couple of weeks, I've had this conversation with multiple clients where we walk through a pricing exercise on their offers, and they realize that their pricing, in one case, they were pricing like 40% too low for what they were doing. So when we come in for CFO clients, one of the first things that we tend to recommend that our clients do, if they're not already doing it, is to have their teams track time on their projects as much as possible. And the reason for that is that it tends to be very eye-opening for the business owner to see how much time is actually going into the projects that they were maybe not aware of before. And while they may think that they're pricing high enough, they realize that they're not. So they realize that they need to price higher to fully account for all of the team's time on the project. This kind of goes hand in hand with team utilization, but in a lot of cases, we see very high amounts of unbillable time for our clients' teams. And what goes into that unbillable time in some cases is work that should be coded to clients, and it wasn't. And if the work doesn't get coded to the clients as billable time, then that means you're not factoring that into your overall project budget, which means that the next time you go to price a project, you're not pricing it high enough because you don't have an accurate picture of your time. So you need to, especially if you have a B2B service business, especially have your team track their time. And I know it sucks to do it, but just do it, because once you track their time, let me say, you need to have them track their time, and you also need to manage it. You need to monitor the time and manage it, because if they're tracking it and you're not looking at the hours to do anything about it, then it's useless, right? So when you are pricing your services, I like to talk about a price floor and a price ceiling. And I think I've talked about this there's a profitable offers episode. And so I will go over this quickly, but go back. It was somewhere in the episode 50 range where we talked about profitable offers. But there's a floor and a ceiling. The floor of your price needs to be like, you need to factor in, okay, every time we do this offer, it takes my team X number of hours to do the work. It takes me X number of hours, me as the business owner, to do the work. And then you're going to assign the pay rates to each of the buckets of hours to get your total cost. Your total price needs to be high enough to generate the appropriate gross profit margin. And so what is the appropriate gross profit margin? It depends on the industry. Minimum, bare minimum, it needs to be 50%. I would say ideally you need to hit 60% or more. If you have a team that you're only paying them for hours worked on the client, then you're probably okay to price at 60 to 65% as your floor. But if you have a team that is salaried, then what you're probably not going to factor in is their unbillable time. And it's not reasonable to assume that your team's never going to have unbillable time, because it's just a fact of life, right? And so if you have to, you're not factoring in when you're pricing that specific job. Like if you're putting in the number of billable hours, you're not thinking about the unbillable time. And so in that case, we usually tell clients, okay, price at 70% or 75%, because that will give you enough wiggle room in most cases to pay for the unbillable time that your team's going to have, and then be left with a 65% gross profit margin. So I would say 50% as the absolute floor. If you're pricing there, though, I would encourage you to think about how you can price higher. I have had clients as high as 80% in terms of pricing margin. A lot of times this tends to be either corporate clients where the amount that you can charge the corporation is just really high, or maybe in coaches, like strategists, people who are doing like that really, really high level service as the offer, and there's no like delivery work or administrative type work involved. So pricing is crucial. Factoring in the floor, right? Obviously, you don't have to price at the floor. So like, I'll be honest, I have clients where if I price at the floor and do 65-70% gross margin, we're charging them more than that because we're factoring in the ceiling, which would be value-based pricing. So pricing is number one. We have to make sure that you are pricing at least at the floor. Go listen to the profitable offers episode. I'm sure my podcast producer will so kindly put the link in the episode show notes for you. In fact, that profitable offers episode starts a whole series about profitability that you should go listen to. All right, so driver number 2 is team. Team costs, especially as you scale, is something that is so crucial to manage. And I'm not saying that like expenses are in any way bad, anything that you should be scared of. It's just a fact of running a business that you're going to scale, you're going to hire a team, and you need to manage the expenses. Team utilization is so important. So paying attention to things like billable versus non-billable time, for example, making sure that you're paying attention to team capacity. And in some cases, you might have your team spending way more hours than you would budget for this project. And so this is up to you as the team leader, the manager, to dig in and help either train them, help get them unstuck so that they're not spending that time anymore. It's up to you to monitor their capacity and make sure that you are filling the sales pipeline and keeping them utilized. So team utilization tends to be a big driver. And once we get in and understand time and where people are spending their time, then it tends to help the business owner set much clearer metrics for, okay, I need to do this much in revenue to be able to keep my team used at full capacity. So those are the things that for client number 2, we work on. We report out on these numbers, we give them the data, we help them pinpoint exactly what is going on and which of the things are driving their profitability down. But ultimately, I always say it is up to the CEO to do the hard work of actually making the change, because me, as your coach, as your mentor, as your CFO, whatever role I'm playing, I cannot do the work to change your business for you. So you have to have the data. You have to be able to make decisions based on that data, but then you have to go and do the work. So in the case of client number 2, we've worked on all these things. What we've talked about in the short term is right-sizing their revenue. And so in this case, what we talked about was getting their revenue back up to about $2.5 million or about $200,000 a month in terms of their run rate, which they haven't been hitting. And I said, okay, in terms of cash flow, like you have a couple months, you should be able to make it until you're able to get more sales and fill up your pipeline and get back to this revenue level. Because at that revenue level on $2.5 million, if they keep the same team costs, then they're going to get to 65% gross profit margin, which is great in terms of benchmark. Then their overhead expenses, if they stay the same, they're going to hit 30-35% in terms of overall earnings. And so sell more, obviously in this specific case, is helpful. But what I see so many times is that the business owner will be like, yeah, I can sell more, I can go do this, and then it doesn't happen. And so we talk to the client and say, okay, you have 2 options. You sell more, but we need to pay attention to it over the next 30 days. If you can't sell more, then we need to start making decisions about your team. Because the next thing to go would be if you're not filling up your team's capacity and you're not able to fill the pipeline, then you have to make the decision to let the team go if you're not utilizing them. And so that would be step number 2. And we're currently in between sort of waiting to see, like, do we have to make that decision or are they going to be able to fill up the pipeline? I guess my point overall is more sales does not always solve the problem. And so in this case, like, yes, they need to sell more while also managing the team to keep the team cost the same. And what's funny is in a lot of cases, my clients will say, well, according to the numbers, my team is not being fully utilized, but they're telling me that they're busy. They're telling me that they can't do a ton more work. They seem busy all the time. And so I think that goes back to needing to have the leadership and management skills to really understand and train your team to be able to do the work and make sure, like, well, are they busy because they're doing work that they don't need to be doing, or they're doing things in a way that's taking too long? For example, there's tons of different things that could be going on. If this particular client cannot fill their pipeline successfully, then they would have to scale back on their team, which sucks. And that, as a business owner, we've got 9 people on my team right now. I will tell you that I'm going to do everything in my power to not have to let go of my team. And I don't know a business owner who would just lay people off and not care about it. Like, we're going to do everything in our power to avoid doing that, but sometimes that's hard. And so I think it's really important as you scale your business up to get the support you need early on to make sure that you're making the right hiring decisions and other investment decisions in your business so that you're doing things at the right time and you have the data you need to be able to make sure that things are on track, to be able to evaluate your business. That was a lot. Hopefully this was helpful. If it was, if you liked this real life story, I have a ton of them because y'all, I see a lot. I see a lot of numbers. If this was helpful, let me know and we'll talk about more. Send me a message on Instagram, send us an email, just let me know. In terms of content, obviously I want to make sure that I'm putting content out that you guys want to hear. If you are in your business in a place where what I'm saying resonates with you, I'm here to help. I would love nothing more than to make profitable businesses the rule and not the exception. So first things first, I have a whole really short course on offers and pricing that is called Offers Priced Right. It is $37. You can go to sarahhyoung.com/store, and I have all my courses that I have in masterclass replays and things that you can get access to there. And so if you need help, you want to go through and start thinking about your pricing and your offers, go check that out. If you are thinking about scaling your business, you're thinking about, growing and hiring a team and managing all the moving parts, then I want to make sure you do it the right way. And you do it in a way that sets you up to be profitable and scale profitably like client number 1 did, instead of getting into a really tight situation like client number 2, if we can avoid that. So if that is you and you want support to do that, then go check out the 6-Figure Blueprint. That is my group program, my coaching program, where I will walk you through scaling your business. We talk about profitability, offers, pricing, hiring a team, setting your metrics, doing the systems, implementing the systems you need to scale. There's no enrollment deadline for this program. We just take a handful of clients every single month and we do weekly coaching calls. You get 6 months of access. And for the month of September, the price is $2,500 for this. I'm going to tell you, by the time we get to October, it's going to go up a lot because I rolled this program out in, was it June or July? And so as I have the first round of clients working through it, I'm seeing the things that they're doing. I'm getting feedback on things to add. It's going to be even better. And so if you've had your eye on it, go check it out. And I will give you coaching to get through increasing your profitability and scaling your business. I can also do this in the format of a VIP day. So if that is of interest to you, go to my website, fill out the contact form at sarahhyoung.com. And lastly, if you are a 7-figure business owner, or if you have a high 6-figure business that you are working on growing into the 7-figure range, and you need the next level of support beyond basic bookkeeping and tax prep to do the things that I talked about that we did with our clients, go check out my CFO services at trustyoungco.com/CFO. All right, so that's it for today. I hope this was helpful. Please let me know if I can support you in any way. I would love to help you make more money, save more money, invest more money, build wealth, do all the things, get all your money on track. Okay, so that's it for this week, and I will see you back here next week. Thanks for listening to this week's episode. Now, I want you to go take some action. What's one thing you can do this week to create more profit in your business? Send me a DM on Instagram at YoungCoCFO and share your action item with me. If you have a question or topic you'd like me to dive into, or if you're feeling empowered about taking charge of your finances, let's continue the conversation. Go to profitandprosper.co to submit a question or topic for me to talk about on the show. And because we all profit and prosper better with friends, please leave me a review on Apple Podcasts, subscribe wherever you listen, and share the episode. Make sure you tag me at YoungCoCFO on Instagram so I can give you some love, and I'll see you in the next episode.